Okay, welcome everyone to this week's stock analysis. I do this every week. I look at one particular stock. You can give me an idea of which stock to analyze in the comments of this video if you want. Then I can analyze that one next week. But this week I chose to analyze International Business Machine Score, or better known as IBM. I did an internship there once actually, so I have some insider knowledge. So what you're looking at right now is a brand new financial platform. It's called Jitta.com, and I'm very impressed with it so far. What you see here, it's actually focused on value investing. So what you see here is the blue line is the price, and the dashed line is actually the intrinsic value, which is a very important concept for value investors because they call it the Jitta line, as you can see here, but it's just an intrinsic value measure. And so what it says here is that it's giving you a score of 7.6. So it scores IBM as a 7.6 out of 10, which is a decent score. And it says it's 34% below the Jitta line, or below their intrinsic value. So in theory, IBM, according to Jitta, IBM is undervalued at this moment. You also have some factors here that they take into account to calculate the score. So as you can see, because they expect IBM not to have amazing growth opportunities, that's why the score is a bit lower here. They also have these signs that revenue and earnings have been consistent, debt levels, share repurchases every year, dividend payouts increasing every year, and we'll see that later on as well. And you can also check here how the Jitta score has evolved over time, and as you can see, it has been decent over time. Stable as well, which is very important when analyzing a stock. You want to see stable companies that are consistently earning above average returns. So let's take a look at what the value spreadsheet actually says. So last week we analyzed Apple. Let's analyze IBM this week. I fill in the ticker symbol. It's now retrieving the data and also performing some calculations. And as you can see, all the data is in there now, and the calculations are performed. And so the value spreadsheet gives a score of 7.0. Jitta gave a score of 7.6, so it's similar, you know. Also, Jitta said that it was about 34-35% undervalued. The value spreadsheet also says around 39% undervalued. So again, sort of in line, which is good. It gives you more confidence in the analysis. However, why isn't IBM scoring this 100? Well, one thing, debt to equity. So let's take a look what is happening there. If we take a look at the inputs tab, for example, we see 10 years of ratios here, and we see that the debt to equity ratio was around 0.5 in 2004. Well, it stayed there for a couple of years, and then it just started increasing and increasing. And at this point, the trailing 12 month, it's actually almost at 2.0, which is very, very high for a debt to equity ratio. And normally this would be a big problem. However, if we look at the financial health tab here, we see the debt repayment period. And what this means is how quickly can a company pay back its debt, which is significant for IBM, with its free cash flows. And actually, it says that IBM is able to pay back all of its debt within 3 years using its free cash flow only. So that is a very good sign, actually, because everything below 5 is actually reasonable. But 3 is just, it's good. I mean, that it means that they have plenty of cash coming in to meet their obligations. So even though they have extremely high debt levels, it's not necessarily a problem for IBM. And if we look at the graphs, what you generally see when a company takes on more debt is that it has more cash, so it can earn more money in theory. And this is what you see here. You see the return on equity is increasing like crazy, and it's at around let's say 80 or something at the moment, which is very, very high. And that's because they have so much debt. You see here the debt to equity ratio, it's just increasing. Net profit margin, the margin is also increasing, so that's really good. So the percentage of revenue that they actually convert into bottom line net income is increasing. So they are able to increase their prices, which is very well. I think part of the reason that they are able to do that is because they are on the cutting edge of technology, right? IBM is one of the companies it is the company that files the most patents of any company in the world each year for several years in a row already. So that just means that they are very, very innovative. They are huge on cloud and big data and cognitive computing, all these things that are just that businesses want, or at least think they want and need. So IBM is profiting from that. So another interesting thing to look at here are these two charts. What you see is the dividend per share has been increasing and increasing. And you only see 10 years of data here, but actually they've been increasing their dividend for 19 consecutive years with an average increase of 13% a year, which is really, really interesting statistic to take into account, because your dividends will just be growing and growing over time the longer you hold on to this stock. And also here, the shares outstanding have been dropping, which means they have been repurchasing their shares and therefore increasing their earnings per share by reducing the amount of shares outstanding, which is good. If we look at the current ratio, it's a bit the same with the debt to equity ratio. You prefer to see a current ratio of 2 or lower. However, their current ratio is around 1.3, which is not that great. However, we already saw that they have so much cash coming in that they can easily meet their obligations. So that is all pretty good. Let's see what else we can find. So we have the valuation here as well, which is also an interesting factor. They are all, if we take the average of these three valuation models, we see that the average estimate is around 225. So why is the discounted cash flow so much lower than that? Well, if we take a look, we can see why that is. Because what the discounted free cash flow model does is it also takes into account debt. So it projects the current free cash flows 10 years into the future and takes the present value of that and adds that all up. However, in the end, total debt is subtracted from the value of those future free cash flows. And because IBM has a significant amount of debt here, 39 billion in debt, that means that the company value goes down, and that's why the discount cash flow model shows a lower valuation than the other models. However, on average, if you take these three, IBM is probably at this moment undervalued based on the JITA score, but also based on the scores created here, or the values calculated here. And the expected rate of return, which is always a very interesting thing to consider, it's explained in detail, the expected annual compounding rate of return. That's what it's called. It's a mouthful, but it's explained in the book Buffettology. That's where I got it from, and it actually shows you how much, if you would purchase IBM at the current price, which is $162, and you would hold on to it for, let's say, 5 years, you could expect to earn an average return of 16% a year, which is a rather nice return, right? However, on the inputs tab, I said that my desired return on investment is actually 20%. So if you go back, it calculates the max purchase price, which is the price that you would need to purchase the stock at to actually have an expected rate of return of 20%. And it's not there yet. So in my case, I would wait until the stock goes below $138, and then I might be interested in purchasing. But at this moment, I'll wait and look for better opportunities. But yeah, IBM, great company, very, very profitable. They have a lot of debt, but it's manageable because they earn crazy amounts of money. So they can easily cover their interest expenses, etc. So yeah, thank you for listening, and hopefully see you next week for another analysis of another stock. And so please leave a comment on this video if you want, if you have a particular stock in mind. And yeah, have a great day.